Let's work through a mortgage note payable example from chapter 15. So the problem here says Sienna Company borrowed $800,000 on December 31st, 2016 by issuing an $800,000 8% mortgage note payable. The terms call for annual installment payments of $119,224 on December 31st. So we need to prepare the journal entries to record the mortgage loan and then the first two installment payments. So first, to record the loan itself. So on December 31st of 2016, Sienna Company borrowed $800,000. So they got cash. So we need to debit the cash to show that the company is increasing the amount of cash that they got. And how did they get this cash? By issuing a mortgage note payable. So we credit the account mortgage payable to make that liability go up. And for how much? It's just that $800,000. The 8% will come into play once we deal with the installment payments. So now our first installment payment. Well, we're paying money, so we know that our cash has to go down. So we will credit our cash, and we're paying off some of our mortgage, but we also will have to be paying interest. So cash is just the amount that we agreed upon for this annual installment payment. So we said it was going to be $119,000, so that's the number that we credit cash for. The next number that we have to find is our interest expense. So we have our interest formula of principal times rate times time. Our principal, in this case, is $800,000 times our interest rate. This is where that 8% comes into play. We multiply it by 0.08 and then times time, which is just our 1 year. So we find that our interest expense for this first year is $64,000. So we throw that up into our journal entry. Now to find mortgage payable, we take our cash and we subtract our interest expense to find that we are paying $55,000 off of our mortgage payable itself. So now let's make a T account for mortgage payable. Initially, we credited $800,000, and then here on December 31st of 2017, we debited $55,224. So we have a balance now in our mortgage payable of $744,000. And it's important to keep this T account of mortgage payable going because you'll see what happens in your next installment payment. Here in 2018, the accounts, the framework of this entry looks the same. We debit interest expense, debit mortgage payable, and credit cash. A few of our numbers will end up being different. However, cash is exactly the same. It's the installment payment amount. But now, when we calculate interest expense, our principal here is going to change. In the last installment payment, our principal was $800,000. This time around, it's $744,000 because we want the up-to-date principal amount. So we take our $744,776 times 0.08. Our interest rate is still 8%, times 1 for 1 year. You multiply that out and you see that the interest expense is $59,582. So we can throw that into our entry as our debit for interest expense. Now, for mortgage payable, we take our cash subtract our interest expense, and you'll see that the mortgage payable amount will be $59,642. So if we update our T account in the lower right, we will debit the $59,642 for mortgage payable, and we'll see that our updated balance after these 2 installment payments is $685,134. So you'll notice that as you are paying off this mortgage payable, less will end up going towards interest and more will go towards the mortgage payable itself. So this works for a mortgage like this. This also works for student loans. So you can take a look at this example and realize that if you're paying off student loans, initially you're going to have to pay a lot of interest. And then as time goes along, you'll be paying less on interest and more on the principal of the loan itself.